Hey guys, Justin with Ready Business Systems. I'm going to show you guys where we're getting our 12% price increase for 2026. So price increases are always a little bit scary, but I've been doing this for a long time now. I've gone through like 5 different price increases and people always stay on. And I always gain confidence by seeing our vendors raising our prices. For example, our rent went from $2,000 to $2,200 this year. That's 10% price increase. Our porta potty service went up by 40%. We use Spotify for music streaming, went up by like 15% or something. So that always like gives me a little confidence with our price increases. But we are I've been a little quiet on the RBS side of things because I spend a lot of time and I'm 100% focused on our pricing strategy because it's so important for the following year, the planning and the strategy. So we start here. We start with our goals for the year, where we want to head, our profit margin. What we did wrong last year is we set our goals and then we set our budget completely separate from that. And that was just stupid. So we said we wanted 20% margin and then we went and planned for 10% margin. So I don't know what we were thinking. But anyhow, we go through here and we very carefully go through each hour of the year. This pricing worksheet, by the way, I'll put a link in the description. It's available on our website. It's a more basic version. If you want something like this, contact us and we'll provide our current version we're showing you here. So basically what we do is we set our budget. So I'm going to show you our charge rates real quick because where the very simple, this was a challenge for me way back when someone showed me this very simple formula and it made a whole lot of sense, right? And then I just made it way more complicated because that's just what I do. And I just made it more precise. But essentially the way you get your the chart you need is you just take your labor per hour, which is calculations for your average hourly labor cost with overtime included in there, and then your payroll burden added on top. So that's going to be your labor per hour. This is exactly what it costs you to pay guys, just because you pay your guys $25 an hour. You tell them I'll pay you $25 an hour. There's a much higher company cost to that, and that's, for example, here it comes out to about 31 bucks. I don't know what our average payroll is per guy, but our labor per hour cost is $31. So you got to get that right, or obviously losing money. Overhead per hour is a little bit less obvious number here. So what we do is we figure out line item by line item how much over our overhead is per year. This is anyone who's not working in the field. So this is like your office, this is your mechanic, this is your rent, your insurance, everything that you're not actually billing on a job. This is your overhead, right? So you take total overhead, but you have to, in order to get this number overhead per hour, you have to know how many hours you plan on billing for the season. So that's super important. And I'm going to rewind back how we got this. When you add these two numbers together, it's going to show you your costs on the job. So this is when you're working. For every hour, essentially, you're paying your guys to work. This is what it costs you, right? You got to get your overhead back. You got to get back your the amount you pay your guys. But the guys don't magically appear on the job site. So there's unbillable time in there. So you got to figure out your unbillable time. You got to add on your profit margin. And we have a markable materials here as well. So this gives us the rate. So at the end of the day, if we want to make 20% margin, we need to be billing $95.14 per hour that the guys are paid. So if the guys are paid for 10-hour workday, we gotta bill out $950 per guy. This right here, rate needed on bids, this just has to do with the unbillable time, so it kind of reverses it out. So if you know you need to land at 95, if you're only billing 6 hours out of 10 hours a day, how much more do you need to charge to land at 95 for the day? So that's where that comes from. So let me just go back to our planning here, and this isn't 100% complete, but this is what we're spending time doing. We go through, we figure out our budget hours per year. So this number here is what we work towards each month. We very slowly and carefully thought through how much work we're going to produce on these months, how many guys are going to be working, how many hours are going to work a week. And we included a buffer in here. For example, our H2B guys that come through this program, we plan on working 60 hours a week. We know they will work more, but we need a buffer in there, right? If it's just like vehicles, if you have no spare vehicles, then if anything goes wrong, you're screwed. So we always make sure that we're working 80% capacity, both of our equipment and with our people. So these people are only budgeted for 80% of their work capacity. So in case we can't find that higher, we can still do that. So we try to be as accurate as possible. We try to be conservative but accurate. We really just try to get these numbers as accurate as possible to make sure we can hit our goals. And as we go throughout the year, we're going to update these. How many hours did we actually work? What was our charge rate that we actually earned? And we plug them in. It's going to overwrite. It's going to spit out our numbers. It's going to overwrite our budget. So we're now updated on the hours that we actually work. So it'll update our profit for the year. So moving forward, let's burn through our overhead costs here. We have our overhead costs for the year. This is directly from our QuickBooks. Not super pretty, but it works. We have our actual numbers, and then this is the budget we're creating for this year. As you can see, we're actually aiming, our goal is doing 1.7 million, but we're actually aiming for 1.8, just the way the numbers worked out. But we wanted to make sure that we're getting that 20% margin was what was most important to us. So a lot of these are calculated out, but we go through our shop parts and supplies. We talk through every line item here. For example, we have our numbers from previous years we take into consideration. We take into consideration the new equipment we're getting. We're getting 2 new trucks. And we figure that out. How many trucks do we need based on the number of hours that we're producing, the number of crews we have. So very painstakingly, we go through every line item here. We figure out how many hours the mechanic's going to work. We figure out, what his maximum pay rate per hour is going to be, including raises. We figure out how many hours, what the guys are going to get paid per hour. So we go through this very painstakingly item by item to determine what our overhead cost is for the year. Down here, we also have our long-term liabilities. So this is the stuff we're financing. So like I said, we're planning in 2 new trucks this year, and we're going to include here the payment when the payments start. So we're not going to get the trucks until March. So that means payments don't start until March. And this is essentially our cash flow. So 2 different equations. One's for our cash flow, and one is for our net profit on paper. Honestly, the only reason net profit on paper matters is if you ever want to sell it, but I care about the cash in the bank account, right? So I keep track of both numbers, but I care more about the cash in the bank account than I do about what the profit says on paper for the IRS or for taxes or for selling the business. But yeah, we have all of our loans here, and we start doing for depreciation to budget for this because this is a non-cash item, right? So depreciation is a fictitious number that you just write off for the IRS. It doesn't really mean anything. So that's where the net profit doesn't really mean anything. You can also mess around with your salary. You can change your profit up and down. It's manipulatable. The depreciation is also manipulatable. But depreciation isn't going to come out of your bank account. What does come out of your bank account is loan payments on your equipment. So we use the loan payments for the equipment for this depreciation number to budget for that, for how much depreciation we're going to have for that year for our equipment. And then we also know we're going to have the cash flow to cover that. So we're budgeting that in. So yeah, after doing all this, we come up with our charge rates, right? So then everything gets kind of moved over here. I was showing you the sheet with the prices we need. Then what we do is we break it up by service. So I took our services last year, right? This is labor only, no materials. I figured out the percentage of our revenue, and we have not gotten to this yet. But what we have to do is we have to manipulate these charge rates that we're going to charge for each service, because we're not going to, even though we need to charge $95 an hour, we're not going to get that from one service. We're going to do it based on our individual services. We can get more for some, less for others, and we change these numbers based on our revenue to come to an average of a weighted average of $95 an hour. So that's what we plug in here. We're going to come up with our charge rates for each one of these services based on our revenue, and we're going to make sure that we're going to be hitting this average rate needed here. We need to be able to exceed that. So obviously we need to increase some numbers. Beyond that, what we do is we go through on our winter audit, we'll go through every one of our accounts, and we look at how many hours we spent, what services they were doing, and we make sure they're all up to date on the prices. So you can see in this tab here, we do our winter audit. So we come up with, once we get our charge rates, how much we need to produce. We're going to spit in all the hours here. You can see all of the different services we provide, how many hours we spent each service. So we have mowing, spring cleanup, fall cleanup. And then right here, we have, this is our mow price. So we're going to come up with the current price this client's paying. Then we're going to come up with the calculated price, right, based on our charge rates for mowing. And then we also have a CPI increase price, which this is the consumer price index. So last year, it went up by 2.7%. So then what we do, our formula, it takes the highest of these 3 prices, whether last year's price was higher, our calculated price this year was higher, or if neither of those, then the consumer price index price is higher. We're going to take the highest of these 3 numbers. In this case, it's going to be the calculated price, and that's the number the customer is going to be quoted for. So that kind of covers us. We do this for all of our services. And then the new customers are going to bid on our new charge rates. So very, very thorough. We do this, and I didn't even show you guys everything. Again, I'll put a link to download it in the description here. If you want a more comprehensive version, please reach out to us and we can help you get this set up for your business. Thanks for watching.